This is Jessica Dunn, and we're going to continue our discussion of cost of capital, more particularly the cost of equity capital. Just as a review, the weighted average cost of capital represents the cost of all capital together. It's the average future cost of capital over the long run. You find this by finding the cost of each type of capital and multiplying it by its respective weight within the capital structure. There are two ways that companies can raise common stock equity. The first is by issuing new shares of common stock, so they issue it directly. Second is indirectly. They take the retained earnings and don't pay them out as dividends, but instead reinvest those earnings in the company. So earnings can be paid out as dividends or they can be reinvested. Investors could buy other securities that earn a return. So therefore, there is an opportunity cost if earnings are reinvested. So the company does have an obligation to earn a strong yield on these reinvested earnings, because otherwise the company could have paid them out in dividends. Investors could have bought other shares of stock that earned a higher yield. So there are three ways of calculating the cost of equity. First is the capital asset pricing model, where the required return is equal to the risk-free rate plus the market risk premium times beta. Second is the discounted cash flow methodology, where the required return is equal to the dividend yield plus the capital gains yield. And finally, there's the own bond yield plus judgmental risk premium approach. That's where the required return is equal to the cost of debt plus some risk premium that would be your judgment to choose. So debt and preferred stock are contractual obligations that have easily determinable costs. It's much more difficult to estimate the cost of equity. These methods that we discussed are not mutually exclusive. When estimating a company's cost of equity, a person may use all three methods and choose their favorite or even take an average. So first, let's look at the capital asset pricing model. When using the capital asset pricing model, it says that the risk-free rate plus the market risk premium times beta is the required return. The risk-free rate is usually measured with Treasury securities. So typically we're using the 10-year Treasury bond. Risk-free rates can be found on the Wall Street Journal, the Federal Reserve Bulletin. You can find them on the internet. There's a nice database. If you Google Kenneth French, the name Kenneth French, the first website to pop up is his, and he has a large database of risk-free rates and market risk premiums. So the historical risk premium uses historical rates as an estimate of future premiums. There are some problems with this. First up, premiums are volatile, so it's very good chance that the observed premiums are going to differ from historic. Second, the historic premium is very sensitive to the period over which it was calculated. In recent decades, the Treasury bond return has been higher than the market in the recent past. Risk premiums change as risk tolerance changes. So if people are more risk averse, then an increase in required premium would cause a decrease in the observed premium. Another way to estimate the market return is through forward-looking risk premiums. The required return on the market is the sum of the market's dividend yield plus the dividend growth rate. But there are problems with this as well. First, analysts have difficulty predicting things in the future, obviously. Second, the accuracy of the analyst's work may be questionable. And third, different analysts are going to have different estimates. And finally, the best way to find the market return would be an expert survey. Again, they're each going to have different estimates. There's no way to prove that a particular risk premium is right or wrong, but a likely range is 3% to 6.5%. So now with beta, so the third component of the CAPM is the beta estimation. There are some problems with this as well. there's no theoretical guidance as to the correct holding period for measuring returns. So should we look at the relationship between market returns and company returns for 6 months, for 10 years, for 20 years? There's no theoretical perfect holding period time. Second, the market return should reflect returns on every asset, even human capital, which is not something that we can measure. Third, some organizations modify the historical beta to produce a more accurate estimate of true beta. And the estimate of beta for any company is very imprecise. With a 95% confidence interval, it's going to be between 0.6 and 1.4. So having your beta as 0.6 would mean that it's less reactive than the market. 1.4 would mean that it's 40% more reactive than the market. So that's very drastically different meanings. But beyond that, it is one of the best approaches that we have. And so let's go ahead and calculate the required return using the CAPM. So the risk-free rate of return is 5.6%. Add to that our market risk premium of 6% and multiply that our beta of 1.2. And that gives us a required return of 12.8%. So again, there are problems associated with the CAPM. The rate on long-term government bonds as an estimate of the risk-free rate. You can argue about whether it should be 10 years, 20 years, 30 years, but typically it's between 10 and 20. Your market risk premium is generally between 3.5% and 6.5%. Your estimate of beta is going to vary, and they are very noisy, but it's still the best model we have for estimating the cost of equity. Let's look at the discounted cash flow method. The discounted cash flow says that the required return is equal to the dividend yield plus the capital gains yield, or the next dividend received divided by the price plus the growth rate, the constant growth rate. Here, with this problem, it tells us that the last dividend received was $3.26. The current stock price is $50, and the growth rate is 5.8%. So step one, we need to calculate the next dividend payable, which is equal to the last dividend times 1 plus the growth rate. So $3.26 times 1 plus 5.8%. So that's $3.45. So now we can plug that into our discounted cash flow method, which says $3.45 divided by the current price of 50 plus the constant growth rate of 5.8%. So that gives us a dividend yield of 6.9%. Add to that our growth rate of 5.8%, and we get 12.7. So with the CAPM, we had 12.8. Discounted cash flow, we have 12.7. So they're very close to each other. So with discounted cash flows, problems are that you often use historical growth rates because you think that it's going to be like it is in the past, which could be a problem. You could look at analyst estimates for the growth rate, or you could use the earnings retention model, which is illustrated here. The earnings retention model says, let's do an example. Let's suppose that the company has been earning 15% on equity, so its return on equity is 15%. It's been paying out 62% of its earnings as dividends. If this situation is expected to continue, what is the expected future growth rate? So we need to look at the earnings retention model equation, which says that the growth rate is equal to the retention rate times return on equity, or it's equal to 1 minus the payout rate times return on equity, because whatever you're retaining is equal to 1 minus what you paid out. So here our growth rate would be equal to 1 minus our payout rate, which was 62%, times our return on equity, which was 15%, and that gives us 5.7%. So that's very close to the 5.8% growth rate that we've been using. But this does make a couple of assumptions. It assumes that your payout rate is going to remain constant, that your return on equity is going to remain constant, that you're not going to repurchase stock or issue new stock, and that future projects are going to have about the same risk as your current projects. Discounted cash flow methodology could be applied if the growth rate is not constant, because we always expect that it to become constant at some point, generally in 5 to 10 years. But calculations get very complicated. Finally, the own bond yield plus judgment risk premium method is where we take the cost of debt and add to it a judgmental risk premium. And this is an ad hoc procedure where the judgmental risk premium, usually between 3 and 5%, is added to the firm's own long-term debt. And so we had already found that the cost of debt was 10%, so then we can add this judgmental risk premium of 3.2%, and that gives us our required return of 13.2%. This judgmental risk premium here is not the same as the market risk premium that we use in the CAPM. It's only going to produce a ballpark estimate, and it's just a useful check. So this should not be the only method that you use. So we had said that CAPM gave us a 12.8% required return, discounted cash flow 12.7%, and the judgmental method gave us a 13.2% rate of return. So you can use one of these, or take an average of these. It's really up to you. Most companies use more than one method. 75% of companies use the capital asset pricing model, 16% use discounted cash flow, and the judgmental approach is not used by companies that are publicly traded very often, but more by smaller, less sophisticated companies. So let's go with the CAPM, and let's say our required return is 12.8%.